welcome to the Hilltop Wealth Advisors Economic and Market Update for the second quarter of 2024. I'm Brittany Brinker-Huff here today with Rusty Erickson, and it has continued to be an interesting year, hasn't it, Rusty?
Oh, it absolutely has been, as always, and glad to be here with you, Brittany, today and talk about what's happened in the first quarter and also what our outlook is. So let me jump into a review of the first quarter here. I would say that three themes that we've talked about previously in our videos have continued in the first quarter. So one of those being inflation and interest rates. For a while now, we, other economists, the markets have really been keying on what is the trajectory of inflation and then trying to infer what the Federal Reserve's response will be with interest rates from that. During the first quarter, we actually saw inflation shifting higher, and that impacted market expectations for what the Federal Reserve will do this year. So coming into the year, the market was expecting multiple interest rate decreases this year. At this point, or during the first quarter, those expectations changed to where now the market is expecting fewer rate cuts and maybe not any. I would say the second theme for the quarter has been continued economic resiliency, both here in the U.S. and abroad. Certainly, there's a lot going on in the world, and we've seen heightened geopolitical risks as well. But in the face of that, we've continued to see economic strength. For example, here in the U.S., during the first quarter, we got a revised fourth quarter 2023 GDP number, and it was revised upwards, and that continued to add some momentum during the quarter and caused certain economists and even the Federal Reserve to raise their expectations for growth in 2024. One of the big reasons for continued strength and resiliency, particularly here in the U.S., is low unemployment and actually labor force participation rate increases. So we've actually seen people who had left the workforce re-enter the workforce. And if we look at this slide on the screen, on the right-hand side, you can see the different components of GDP. And about 2/3 of the U.S. growth is driven by consumer spending. So when people are working, when they get a paycheck, they have a tendency to spend that money, and that tends to be a positive thing for the economy. I would say the third theme for the quarter has been continued stock market growth. So for example, here in the U.S., the S&P 500 returned a little bit over 10% for the first quarter. Smaller companies less, closer to 5%. One interesting thing to note is we look at the different 11 sectors of the stock market, 10 of them were actually positive in the first quarter. The only one that was negative was real estate. And that had a lot to do with inflation and interest rates, which I talked about earlier. But if we look outside of the U.S., markets were positive there as well. Developed markets returned about 5%. Emerging markets returned low single digits, but we're still positive. So that theme of equity returns being positive continued in the first quarter. So that was a quick review of the first quarter. Now, Brittany, I'll turn it over to you. How does that impact our outlook for going forward?
Yeah, definitely. We'd certainly say that despite some of the mixed economic news that we've had over the past few months, our outlook for the U.S. is still quite positive, largely supported by many of those trends that you mentioned. Strong consumer spending, stable consumer confidence, low unemployment rate. So those are all good things. But we would also think that growth in the U.S. will continue to moderate and slow slightly. A key figure that we're going to continue to watch is definitely inflation. Like you said, we saw a recent uptick in those inflation numbers in the past few months, and we can point to certain sectors of the market that have been causing that stickiness. So longer term, we think that inflation will continue to decline over the coming months and quarters. But that being said, it's unlikely that we're going to see the super low inflation rates of the past 20-some years anytime too soon. So in line with that, it is quite likely that the Fed is not going to be cutting interest rates quite as soon as was expected at the start of this year, although definitely still possible that we might see some rate cuts before year end. It's really just going to depend on the economic data that comes out over the coming quarters. At the same time, we also think we'll see companies continue to lean into the artificial intelligence space, which will likely cause continued excitement in the market and potential new areas for growth. Internationally, we're likely to also see many economies' growth continue to moderate as a result of high interest rates doing their job. So you can see in this chart here that many developed markets are poised to likely see some interest rate cuts over the coming timeframes. I think the main outlier here, though, is China, which is in more of a contractionary phase at this point, and barring any major policy shifts, is likely to stay in that position for a little while. So in terms of some risks that we're keeping an eye on, we mentioned interest rates, inflation. Those items could have a longer term impact on the economy, but there's also some shorter term items that we're watching as well. The US presidential election is certainly one of them, as well as just geopolitical tensions outside the US. Also, both of those items could cause some more shorter term market volatility. So we'll certainly be looking to see if there are any opportunities in the market that arise as a result of those. So in line with that, Rusty, any thoughts on how Hilltop is positioning our portfolios given this economic environment?
Yeah, absolutely. I would say that two themes, once again, that are continuing from previous quarters would be balance and diversification. So if we think about the three different kind of pieces of our portfolio, the first being equities or stocks, we continue to be diversified across multiple dimensions. So in the US, we have large companies, mid-sized companies, and small companies. And then we also have international investments, both developed and emerging. Now, we have more invested here in the US than we have internationally, but we continue to have those international investments for diversification benefits over time. That second piece that we think about of our portfolio are the alternative investments. And we continue to have a desire to have those be income producing as well as a little bit of a defensive tilt. So for example, we're using a healthcare fund, as well as we've increased our allocation to the NASDAQ Equity Premium Income Fund that we've had. Now that fund is designed to generate returns that are largely consistent with the NASDAQ 100, so a very tech-heavy portfolio, but to do it in a way with less volatility. So it's probably not going to have the same gains when the NASDAQ is up as much, but it also doesn't have as much volatility on the downside. So those have been some of our focuses on the alternative piece of the portfolio. And then we have bonds also within the portfolio. And we continue to maintain a focus on having higher quality bonds to add to diversification and reduce overall portfolio risk. One other thing I want to mention, it's not really part of our allocation, but we've certainly talked a lot to clients over the last year about their cash reserves. With interest rates being higher, you can now earn more on your cash reserves than you could a couple of years ago. And when I look at the marketplace, I think that a competitive rate right now for a money market or a one-year CD or a savings account is probably somewhere around 4.5%, maybe 5% or more. And so if you're not earning that competitive rate, you've probably got some lazy cash reserves. And we would encourage you to look for something that's a little bit more competitive. And of course, we're happy to talk with clients about that as well and help them find some options if they would like to discuss that with us.
Definitely, yes. Nice to have cash actually earning some interest right now. Good to take advantage of it.
Absolutely.
Well, thank you, Rusty, and thank you all so much for watching. We hope you enjoyed this and learned something. And if you're already a Hilltop client, know that we really appreciate and value the trust you have in us. And if you aren't working with Hilltop yet, you can reach out to us by going to our website, hilltopwealthadvisors.com, and clicking contact, or by scanning this QR code. Just know that we would love to talk with you. Thank you.